Okay, so now we're going to look at short-term notes payable. So these are the notes that are going to be due in less than a year. And so here we go. We could be issuing a short-term notes payable because we want to borrow money. It could be to pay off an account payable, or we could use it to buy an asset. So when the note is issued, the face amount is what we're receiving, the proceeds of the note. So the cash that we receive if we're issuing it to borrow money, the accounts payable amount if we're issuing it to pay off an account payable, or the cost of the equipment, the purchase price of the equipment. And then when the note is due, we pay back the face amount and the interest expense. So let's say we issued a $3,000 3-month note to pay an account payable, right? So back in the receivables chapter, we talked about our customers that maybe couldn't pay their account receivable. They needed more time, so we had them give us a note, right? So we had a note receivable when we were the one getting the note from our customer. Well, now we're on the other side of the transaction. We're the customer. We're having a cash flow problem. We can't pay our vendor, so we give a note to pay off our account payable. So in this case now, the account payable is turning into a note payable. So we debit accounts payable. Accounts payable is going down because it's not going to be an account payable anymore. Now it's going to be a note payable. So note payable is going up. So that's why we credit it. Let's say we issued $3,000 3-month note, 10% to get cash. Well, if that's the case, we're getting cash. We debit cash. We credit notes payable. Now we have a liability we owe on a note. Let's say we issue the notes payable to buy inventory. If that's the case, we debit the inventory, we credit the notes payable. So when we give a notes payable, we're incurring a debt, we debit the notes payable. We credit the notes payable, we debit whatever it is we're getting for the note. Now, let me go back. So it's a 3-month note. Okay. If we issue the note and then pay it back in the same accounting period, well, then when it comes time to pay off the note, we just can record the interest expense at that point in time, right? If it falls in the same period. But let's say that doesn't happen. Let's say we issued that note on April 1st, but our fiscal year ends on May 31st. Right, so if we issue a 3-month note on April 1st, April, May, June, that means it's going to be due on July 1st. Okay, and so our year ends on May 31st. We can't wait till July 1st to record the interest expense because some of that interest expense was incurred in this accounting period. Actually, April and May, 2 of the 3 months interest expense was incurred in this period. So we have to make a journal entry to record the interest expense that had been incurred as of May 31st, right? If it happened in this accounting period, it needs to be recorded on this accounting period's financial statements. So let's take a look at the interest that we've incurred on the note. $3,000, 10% note, that means $300 is a year of interest, right? But we didn't incur a year of interest. We incurred April and May, 2 months of interest. So we multiply that by 2 divided by 12. So $50 is the interest expense that we have incurred in this fiscal year. We make an adjusting entry to debit interest expense, 50, credit interest payable, 50. And then when it comes to the maturity date of the note, we're going to pay off the $3,000 that we borrowed, but we're going to pay 3 months of interest. Principal times rate times 3 months of interest is 75. We're going to pay $3,075 in cash to pay off the note. So we'll credit cash $3,075. We'll debit notes payable for the $3,000. And then we're going to record the June interest, right? June, we incurred 1 month of interest. Principal times rate times 1 divided by 12. So we incurred $25 of interest expense in this period. We also need to debit interest payable for 50. We have to show that we paid off the liability that we recorded on May 31st. On May 31st, we said we owed 50. Well, now on the maturity date, when we pay the $3,075, we don't owe the 50 anymore. So that's why we debit interest payable. So make sure you are taking care of everything that's happening. Take into account that there was $75 of interest, but 50 of it was recorded as interest expense last period. 25 of it is interest expense in this period. Okay. And as always, make sure debits equal credits. Okay, we're not going to spend time on payroll taxes because that's just more involved than what we have time for. But you will see a lot of current liabilities on a balance sheet relating to payroll taxes. We want to look at some estimated liabilities. So one would be your warranty liability, right? So if you sell your product and let's say it has a 1-year warranty, okay? So at the time we make a sale, we don't know which products are going to record liability. We know which ones are going to incur warranty work. If we knew a product was defective, we wouldn't sell it. But because of our matching rule, we have to record the warranty expense in the same period as the sale. We can't wait till it comes back in the next period for warranty work. So at the time of the sale is when we need to record warranty expense, and we're going to estimate it. And so we can look back on previous period sales and see what percentage of our sales was brought back for warranty work. So based on that percentage, we'll apply that to this period sales and assume a similar percentage will be brought back for warranty work. So as an adjusting entry in the period of the sale, we'll debit warranty expense and credit estimated warranty payable. This way the expense is reported in the same period as the sale. We're matching the revenues with we're matching the expense with the revenues that it helped to generate. And then when we do get one of the items that we sold, a customer brings it back and we do the warranty work. Maybe we're just replacing the item. We debit estimated warranty payable, credit merchandise inventory. The last estimated liability we want to talk about is contingent liabilities. A contingent liabilities is a potential liability. It will be incurred if a certain event occurs in the future. So you really could consider warranty work a contingent liability, right? You will have the liability if the product breaks, right? Another common one would be a lawsuit. We will owe money if we lose the lawsuit. And so the way it works with contingent liabilities is we record the contingent liability if it's probably going to happen and we can reasonably estimate it. Both of those things need to be there. If we can't reasonably estimate it, or if it's only possible that we could have the liability, then we just disclose it in the notes to the financial statements. So a lawsuit that we can't estimate or that we're not sure we're going to have to end up settling, we have to talk to our lawyers about precedent in the area that we're being sued in, right? And so we may not have to record it as a liability. We might just be able to, in the notes to the financial statements, say that we have a potential liability. If the possibility of it happening is remote, there's no action necessary. So let's say, here's an example. An automobile introduces a new car. Past experience demonstrates that lawsuits will be filed as soon as the new model is involved in any accidents. We live in a very litigious society here in the United States. People file lawsuits for things that, are pretty frivolous. If you know somebody and you can get them to sue, take on your case and sue. We see that happening quite frequently. But we're not going to report any of this. We're not going to report this. The amount's not subject to estimate. There's no amount. And also, if we were to put in the notes to the financial statements, what would we really say? That we have a new car, it'll probably get sued. We probably will get sued. I don't know that that's any new information. Here's another situation. As part of a land development for a new housing project, we polluted a natural lake. Under state law, you must clean up the lake once you complete the development. It'll take 5 to 8 years. So in 5 to 8 years, we are going to have to clean up a lake. It estimates that it'll cost $2 to $3 million to clean up the lake. So we're going to have to report this liability. It's probable because there's a current state law. I suppose laws could change, but that doesn't seem the direction that our laws are going in. We're getting more and more about sustainability and being green. So, pollution, there's consequences for pollution. And we can estimate it. So since the amount can be estimated, the loss seems probable. We're going to have to make a journal entry to show that we owe between 2 and 3 million, right? Companies don't like to have to carry liabilities on their balance sheet. If you think about financial analysis, which changes our debt ratio and makes it more risky to get loans. So we don't like to show the liabilities, but this meets the threshold for having to record it as a liability. So for 5 to 8 years, we're going to have that $2 to $3 million liability on our balance sheet. Your company has just been notified that it lost a product liability lawsuit for $1 million that it plans to appeal. Management is confident that the company will win on appeal, but the lawyers believe that they will lose the appeal, that we will not owe the $1 million. So we are saying, the lawyers believe that we'll lose and that we'll have to pay. So management is saying, we're going to win. We don't need to, record a liability for $1 million. As I said, companies don't like to show big liabilities, but it's going to depend on what the auditors may not give you an unqualified audit report unless you record the liability. So that's going to be a discussion between the company and the auditors. Key customer is unhappy with the quality of a major construction project. The company believes that the customer is being unreasonable, but to maintain goodwill has decided to do $250,000 in repairs next year. So sounds like the loss is probable. Sounds like we're going to do it. We know how much the repairs are. So this is going to be one that we need to record a liability for. So just to summarize, when you have a contingent liabilities, there's 3 possible courses of actions for treating it. You record the liability if the contingent liability is probably going to happen and you can reasonably estimate it. It has to be both. You disclose it in the notes to the financial statements if it's probably going to happen but you can't estimate it, or if it's possibly going to happen. And then if there's just a remote chance that you could have this liability, then you do nothing.